appreciate you joining us tonight for what I hope will be a informative and enjoyable session together, kind of looking through a little bit of 2022 and looking forward a little bit to 2023 and how we're thinking about markets and your portfolios. On the call tonight with me, I have Audra and Ben. Most of you know Audra and Ben here at Simmons, and I'm excited to have them with me tonight to kind of walk through some of our thoughts with you. A couple of times throughout this call, we're going to be throwing out a couple of polls. So if you're willing to participate and answer the questions on your screen as they come, that would be really helpful. At any time, too, you're also more than welcome to submit a Q&A for us. You'll see a little Q&A chat box probably down in the lower part of your screen. Feel free to submit that question to us, and we'll be monitoring those as we go through the call tonight. We welcome your questions and your feedback as we go. So thank you so much again. I hope that you find tonight enjoyable. And it certainly has been an extremely challenging year in the markets, I guess, to say the least. 2022 will be a year that we certainly will be happy to forget once we get through it. But in the interim, I think it bears noting that tonight is not a prediction, right? We're not a crystal ball type of money manager. I wish we had that proverbial crystal ball. That would make our lives a lot easier. But really what we're looking to do tonight is to just provide some really objective, thoughtful analysis, and rather than predicting, helping you to kind of make decisions about your own investments in a way that is smart and rational and prudent. I really like this quote as I was preparing for tonight that says there are two kinds of forecasters: those who don't know and those who don't know that they don't know. Ultimately, we do not want to be those forecasters who don't know that they don't know. And so ultimately, we'll kind of go through this tonight. And again, thank you for being with us. So let's get straight into it. As we were preparing for tonight's call, there's really no way to sugarcoat the fact that 2022 has been a pretty brutal year all the way around the financial markets. Almost every category of investments have lost money this year. And what I think is really an interesting chart is this that's on the screen here in front of you, which is really looking at different mutual fund categories. So that's going to span, stocks, bonds, and within stocks, within bonds, there's real estate. Pretty much any type of mutual fund category that you can think of is included in this chart. And as you can see, over 93% of different mutual fund categories have lost money this year. That, as you can kind of see, 2018 was not a great year, 2008, 1994. This is not common, right? Where so many different types of investments are down and negative for the year. And that's made this year extremely difficult because for most investors, the thing that they hold for safety is generally bonds, and that generally offsets some of the risk in stocks. And this year, unfortunately, bonds have had a really rough go of it too. So it's been a pretty tough year as an investor all the way around. Audra and Ben, as we were putting this together, I used to have a sad face emoji. They suggested that I should throw in a Santa, a sad crying Santa. And this particular picture actually has empty pockets, which I think is quite apt for the current environment that we're in. I'm going to quickly ask Ben to throw up a poll for us on the screen. And if you would mind kind of submitting your answer, that would be really helpful and enjoyable for us to see. And Ben, if you want to throw that on there for me, we're going to kind of talk through one of these polls, which is ultimately the first one. How many times have stocks and bonds been down for 3 consecutive quarters in history? So let's see. Ben, are you able to get that on for us? Let's see. Let me see if I can get that.
There we go.
All right. So the question again, and please submit your answers as you can. How many times in history have stocks and bonds both been down for 3 consecutive quarters? And let's give it a couple of minutes. We'll see what kind of answers come in here, and we'll jump a little bit back and forth between those. All right. A lot of answers centering around fewer than 2 and between 3 and 5. You're getting the gist of it. It's a rare occurrence. All right. Let's end the poll there. And let's take a look at the results. Audra, did the results come up?
Yes, they did.
All right. So 67% said fewer than 2 times, and 33% said between 3 to 5. Both very informed guesses. The answer is, in fact, fewer than 2 times. The only other time was in 1931. Anytime that you're sharing financial similarities to 1931, Great Depression era, is not generally great. So ultimately this year, again, very, very rare that both stocks and bonds have had negative returns for such an extended period of consecutive time. Thank you very much for participating in that. There'll be another poll coming up a little bit later. So this chart again shows us a little bit more about that. And the reason that this year has been so challenging primarily is because interest rates have been rising so rapidly in response to really persistent and sticky inflation. Today there was a little bit of a bounce in the markets. Chairman Powell came out and said that he expects interest rate hikes to kind of moderate and slow a little bit in the coming in the coming hiking cycles. The market was obviously happy about that. A couple of weeks ago, the CPI inflation print was 7.7%, which was a little lower than the market expected. The market rallied the most it has in 2 years. So clearly the market is extremely tied in and very honed in to inflation and interest rates. The problem, and I would say, we probably need to hold the champagne a little bit relative to the CPI print that we saw a couple of weeks ago, is that as inflation has kind of hung around for as long as it has, it starts to become more entrenched in the economy. I've shown this chart on previous calls before, but really what we're doing is breaking out inflation into different components. Some of those components are more transitory or more kind of influenced by supply and demand types of dynamics. So things like gas, for example, you can see green gas, back in the summertime, really, really high prices. That's come down a lot, even just in a few months. So that's an example of a more supply-demand transitory type of inflation components. But the concern for us is more that there's other sticky components of inflation. A good example of which might be rents, right? If you're a landlord and you raise rents on your tenants because inflation is running wild, it's fairly unlikely that you're going to kind of turn around and reduce your rents on your tenants if inflation starts to turn the corner. So sticky components take a long time to adjust upwards, but once they do, they also don't come down very quickly. And so, if we kind of eradicate all of the transitory components and just look at sticky components, we're at about 5% in terms of inflation currently. The Fed's target is about 2%, so there's quite a ways to go. And certainly without some sort of recession, I think that might be some real challenge to get back down to that 2% target, just because sticky inflation has become very entrenched, roughly 2% higher than it was even 1 year ago. So again, we'll certainly happy for any updates in the market and any positive developments, but I think we do need to be a little conscientious and careful to celebrate too soon that inflation is no longer an issue. One of the main concerns about raising interest rates is that there's a potential that can lead into recession. And we've been getting a lot of questions about this. So Audra, why don't you kind of talk us through a little bit about recession, some of the questions that we're getting asked, and kind of take it from there.
Okay, well, obviously I've been tasked with kind of bringing you some information on recession, what causes it, what indicates it, and how are we all going to live through it. So one of the ways that we thought we might kind of kick that off is to actually share with you the quote above that kind of cracks the door to having a conversation about what the cause is. The gentleman that spoke this quote is the author of a book called The Psychology of Money. And Darren will continue to talk about psychology and behavior and how, as always, that creeps up in all of our heads and makes us sometimes make choices that maybe we would be ill-advised to make. So nothing too good or too bad stays that way forever. Because great times plant the seeds of their own destruction through complacency and leverage. So I'm going to pause there for a second and see if that reminds anyone of a time back in 2008 when we were all, well, leading up to 2008, I should say, when we were living large and we were buying houses and we didn't really have to worry about credit or credit checks and all kinds of rules and regulations at that time. and everyone was happy as clams and doing their thing, and mortgage investments were flourishing. Well, as we all know, that bubble started to rise, and as with everything, it hit the ceiling and exploded. And just as the statement says, we planted the seeds for our own destruction, and we leveraged it and we played around, and it burst. And the bad times planted the seeds of their own turnaround through opportunity and panic-driven problem solving. So with that said, by mid-June of 2009, we began to see, just as those little seedlings to the right show, the rising from the ashes of something beautiful and green beginning to grow for the sky again. So a market picture below certainly can tell the same story as those little seedlings up above. Is we have really been living in that time of expansion since 2009. We stayed the course, and we have been rising from those ashes. However, like everything else, our memories are very short. And now, after more than a decade, we're entering another cycle, and no one is probably too happy about it. But really tonight, our message is going to be the fortitude of staying the course and looking beyond the moment so that you can reap the benefits of what's yet to come again. So on our next slide, what we wanted to kind of talk about is, again, being cautious to not fall into the trap of, as soon as you see something, making a change. Because something very unique goes on with respect to stock market versus the economy when it comes to evaluating an impending recession. And that would be described as a mismatch. As the market is basically looking ahead of us a year and beginning to position itself and plan accordingly, those economists that are trying to determine and share with you when they think a recession may be upon us are looking backwards 6 months. So now we have this huge disparity in time, such that if all of a sudden today you say, wow, the market just spiked today, I guess everything's great, I'm gonna just keep going along and shooting for the moon. Well, remember, some of those things might only last a day or a week. And things have already begun to fall into place as far as indications that we may be headed for something. And that really began a year ago. Darren will speak a little more deeply on some of the changes that we began over a year ago to date, as we saw that ride we've been on since 2009 is beginning to slow and come to a close. There are certainly many indications of recession and triggers for recession. Inflation, supply chain issues, as we spoke, world events. And as you've already seen, there's action that's been taken, and very delicately, everyone is attempting to slow the horses as calmly and slowly as possible. But the biggest message to be that it's a necessity. This is part of the cycle. It's a healthy part of the cycle. And in order to let things climb again, as in our prior slide, you have to go through this time of reconciliation. And that is really the period that we see coming ahead. Yet that doesn't mean get off the bus and wait till it's over, because as far as figuring out when that entry point is going to be and where that exit point is going to be, we are more likely to be on the wrong side of it than the right side of it. So as always, our underlying message tonight will be to stay the course. Take a peek at the chart here. One of the interesting things that it's showing is, as right now, this whole year, we have lived through this up and down yo-yo of a year, which probably is more normal than the continuous upward spike that we lived through the year prior. But what was very interesting to see here is, as we come through these volatile times and after we have felt the deepest pain, there begins to be this calming of the storm, as if you move into the eye and things are just steady as the cycle continues. So 3 months prior, you can see flat, negligible positivity. During the actual recession itself, depending on how long it might be, again, a similar level of stability. And as things begin to turn ahead and everything begins to come together and the economy begins to expand again, we start to flourish and we start to rise, as you will see in the years to follow. So like every good thing, sometimes like a fine wine, you need to really wait it out. And that doesn't mean waiting it out at home or waiting it out in cash. It's really being mindful and knowing that we are really trying to be proactive, but to keep everyone moving forward.
That's great, Audra. And that's a great explanation. I think just to add some color to that, just kind of conversations that we're having with clients, I'll often get the question from someone, well, if we kind of have a sense that recession's coming, why not just, when the recession's here, get out the market. And then once the recession's over, we'll get back in. And of course, that sounds wonderful in theory, but it's really difficult to execute because of what Audra mentioned, which is that the market is looking ahead 12 months and recessionary data is looking behind us. Ultimately, by the time the recession's declared started, the market's already dropped, which is why this chart here shows you that, 3 months before the recession, the market doesn't really move that much because the main movement down has been, occurring 6 to 12 months before. And then at the end of the day, waiting until the recession is officially declared over means that the market's probably already 12 months ahead of you and ultimately has run out and recovered far ahead. So just to kind of reiterate those points just from, common client questions, that's really the reasoning behind why we don't necessarily want to follow that kind of path of trying to invest around when recessions are officially announced or declared over.
So this next slide, again, we're hoping that it actually will be informative, but also inspiring on some level, is how long do recessions last? Well, immediately you're seeing two vastly different blocks going on here. You're seeing high spikes with great width, and you're seeing low points that in most cases are rather shallow and short. So just as you're seeing, and just like that statement and quote that we gave, nothing too good or too bad stays around forever. However, it appears by historical figures, which as always, we have to take with a certain grain of salt, but looking back quite a substantial amount of time, the great good times have far outlasted those down times. It doesn't make the down times any less painful. A good day and a bad day are still 24 hours. However, it really gives you the staying power to wade through a recessionary period looking for the pot of gold on the other side.
That's awesome. So Ben, we have another poll at this point about recessions, and I wonder if you can throw that up for us on the screen. And basically, this next poll is going to say and really ask you the question of when do you think that the next recession will likely start? And there's really 4 answers. Either it's already started, first half of 2023, second half of 2023, or we won't go into recession at all. So Ben, if you're able to throw that up for me, that'd be great. Is it up?
I don't see it.
Let me try. I can try and launch it.
There we go.
All right. So let's see what you guys think. Let's see what the answers are.
And keep in mind some of the recent education you've had about looking back and looking ahead.
Interesting. All right, let's share the results. All
Very
right.
Interesting. I must say to all joining us tonight, this is not what I would have expected.
Yeah, no one thought that we won't go into recession, so we have a bunch of pessimists here on the call tonight, or realists maybe. So the majority, it's already started, and about split half between either the first or second half of 2023. Interesting.
All right. Well, I will go ahead and reveal what we feel is the best interpretation. Should I give it up first or should I go through the indicators?
Yeah, give it up.
All right. So what we perceive as the correct answer would be the second half of 2023. And I'm going to tell you a little bit why we think that. Basically, the chart you're looking at here is talking about what the indicators are that warn you of an impending recession. And basically what you're seeing on this chart are the spikes above the line are, again, the expansion, the positive times that we've had. And the times where it crosses zero and goes below, many times are the times that are beginning to tee up a recession. So some of the indicators will likely feel very obvious to you. Slowing, changing, and slow job growth, the slowing of housing sales, the slowing of building and developments, the issuing of permits, the slowing of ordering of new goods. Now, some of you might say, because of all the oddities that came from COVID, that, well, what do you mean? There's all kinds of, cars orders yet to come in and all kinds of supply chain things. Trucks are moving and bringing things all over the place. But keep in mind, those were orders placed long before now. Things are catching up and it's skewing some of the realities that are really going on. But as far as new buildings, just getting ready to get started, housing sales, we've seen this radical shift and coming down. I live, just north of here, where you could sell a shoebox, for $500,000 a couple weeks ago or a couple months ago. And now things are kind of right back down into that normal 1% above their normal selling price. Things are slowing. It's very noticeable. Certain things are slowing, but not stopped. As far as jobs growth, there's certainly still a lot of opportunity for positions out there. So some of things are slowing, but they're not stopped just yet. But we still would consider these indicators because we have seen this line go below zero and it's starting to stay there. It's not popping right back up, where if you looked back around just 1998, 99, whatever on their chart, where it was a tiny little moment and popped back up, that really would not have been a sustained recessionary period. So we're starting to see some time passing and that line staying down there. So that is definitely giving us a thought that we're walking closer. But again, based on the timeline, we anticipate we're 6 to 9 months out until we're really going to be in that moment. The next big question will be, how long will it be? Again, sadly, I too do not have that crystal ball that we so wish for every Christmas. But in general, there are still a lot of very positive things that might lead us to think that it will not be anywhere near as long as this wonderful 10, 12-year run that we have had of an expansionary period.
Mm-hmm. Those are great points. I think it's important to kind of maybe address the fact that so many answers came back saying that we are already in a recession. That's really interesting, but it's also not that, I guess, not that uncommon, just because it's been all over the media and written like that. But I think it's important to note a couple things. Number one, that although the first 2 quarters we did have technically negative real GDP growth, real GDP is adjusted for inflation. That means that because inflation was so high, when you basically adjust it for inflation, it looks negative, right? The growth isn't enough to overcome inflation. So, that's more of a technicality, to be honest, more than anything else. In addition to that, when you really look beneath the surface of what definition has to make up to officially qualify as recession, it's actually more broad-based economic weakness than what we've seen. Right now, we have such a mixed bag because, as Audra rightly said, there's certain areas that are definitely showing weakness and cracks and outright deterioration, but there's a lot of other areas that are actually still quite robust and quite strong. So typically, in order to qualify as the definition of a true recession, it's not just 2 consecutive quarters of negative economic growth. That's the easy kind of headline, but that's not really it. Beyond that, we need to also have, job market weakness, spikes in unemployment, which we haven't really seen yet. So things like that. So that's again why, although it's an easy headline to write that, hey, we're in a recession because we had 2 negative quarters of real GDP growth, there are a couple caveats to that, and I think it was worth just maybe mentioning that. As Audra rightly said, the reason we like this chart and follow this chart is because these shaded gray areas are past historical recessions. And you can kind of see as these indicators decline and break through the negative, followed by recession, declining, breaking through, recession, pretty much without fail. As those economic leading indicators decline and break through, recession traditionally has always followed. And so this sustained decline through that zero line does certainly point to a pretty high probability of recession. Typically, the lag is about 6 to 12 months, which is why it puts us out to more mid to late 2023 would be our guesstimate. If we were forecasters, which we are not, by the way. So hopefully that's helpful so far. Thank you, Audra, for a really good overview of just recession in general. Again, recession is not something that I think we need to invest around. It's important to adjust our investment allocations. It's important to, play offense and defense at different times, and especially to look at the composition of what makes up our portfolios, because certain types of stocks do better than others during recessionary times. So that's what we've been working really hard on for you guys. But ultimately, to get 100% out of the market and back in light of upcoming and pending recession is probably not the best long-term sustainable strategy. Speaking about sustainable strategies, I thought it was helpful to maybe just kind of go back to investor psychology 101. We've been through a period of time over 2021 where things were really good. And I think this chart is pretty fun to kind of walk through. As investors, obviously we're emotional creatures. We know that emotions shouldn't really factor into our investing, but we're humans and they do. So ultimately, as the markets go up, we start to feel encouraged, start to feel confident. We're pretty thrilled. And towards the end, we're pretty euphoric, right? I would say towards the end of 2021, people were pretty euphoric. There was just a tremendous amount of money flowing into really speculative investments. Cryptocurrency was a major thing. Even more innovative investing in things like the ARK investment ETF, which is really innovative type of young companies. Shooting the lights out, doing fantastic. And the reality is, investors kind of get greedy during those times, right? It's like, wait, I put in $1 last month and it went up to $2 this month. This is easy. But the reality is most investors tend to want to buy around this time. So as they're feeling thrilled and euphoric, they start to rush in and really start to put money into the markets. As things start to turn on the other side, I guess we could categorize that as maybe early this year. So kind of first quarter of 2022, people kind of get surprised. Wait, markets actually go down? Yeah, they do. They do, in fact, go down. As things continue to fall, you start to get nervous. You start to get really worried as things fall past a certain level. And again, the financial media doesn't help because at the end of the day, they really pile on, right? As these kind of fears get exacerbated, it's much easier to write about really scary things. And so people get more nervous and more worried as they go. What's, I think, a little bit interesting is that you often in market times, kind of in these bear markets, you tend to get these bear market rallies that we've kind of seen. And some of the biggest rallies throughout history have actually happened during a bear market, right? So even though the market's trending downwards, you have these really big rallies, sometimes 10, 15, 20%, that make people think, hey, the bear market's done, everything's good, the coast is clear. And that's kind of a little bit here, people start to feel a little bit more confidence. I fear that may be where we are kind of today, to be very honest with you, somewhat of a bear market rally. And then eventually things turn around and ultimately they fall and panic befalls us. And I think this is a really interesting part of bear market history is bear markets typically don't just end, without some sort of bang. Normally they end when there's what's called capitulation in the market, where people are just like throwing in the towel, saying, I can't take it anymore, go to cash. And that's when investors tend to sell low, right? So again, we know this as investors that we should avoid that. We should ideally be buying low and selling high. But to put some quantification on this, this is kind of an interesting study of 3-year returns based on the direction of stock flows, so flows into stock funds over time. And following the herd, or basically buying when others were buying, this is your return, roughly 5.5%. During this time frame as referenced, by the way, the S&P was at around 11% on average. And then if you're ultimately buying when others were selling, so buying low and selling high, your return, roughly 3 times greater. So again, I think it's just important to revisit those really basic kind of investment philosophies. As longer term investors, we have to continue to fight the urges of emotion. If we're well invested and well kind of diversified and have those kind of appropriate risk levels, then hopefully we can avoid the panic-stricken phase where people want to sell and throw in the towel. That's always the goal. But ultimately, we got to remember this for next time, that even, towards the end of these good times when we're thrilled and euphoric, we have to be a little bit careful about, getting overly optimistic and overly excited. This is kind of a cool chart because we've been showing this for a long time, but this kind of moves pretty well in line with what I just showed you, right? Where this euphoria coincides pretty well with the end of last year. We showed this chart a few times, where this is basically a measure of how expensive the stock market was and is. Ultimately, this is prices in light blue and earnings or profits that companies are making in dark blue. And when there's a big gap and when prices are way above profits, that basically indicates an expensive market. You're paying a lot of money per unit or per dollar of profit. So this is kind of the euphoria, right? People just, again, forget about actually worrying about what they're paying for a stock. They just want to buy it because they know it, or they think they know it's going to go up. So ultimately, that's a big indication there of euphoria. On the other hand, once we kind of come out of a panic-stricken phase, we start to get kind of the opposite, where prices are below earnings and profits. And interestingly enough, this was coming out of the 2008 financial crisis that Audra alluded to earlier. And this here, you would say, okay, well, stocks are probably fairly cheap. But remember, coming out of 2008, most investors did not want to own stocks, right? They were scared. They'd sustained major losses, and the scars of sustaining big losses can sustain for a long time. So ultimately, again, as investor psychology goes, kind of in opposite to this, when we should be, they're buying in here and selling in here, we really want to be buying in here and selling over here to the best of our ability. But where does that bring us to today? Well, ultimately, as much as it's been painful to see these stock declines this year, one benefit is that prices have come down. And now prices relative to earnings are much more closely aligned. And you would look at the market and say it's much more fairly valued or more realistically valued today than ultimately it was at the end of last year. So that's a positive thing. Now, this is certainly not to say that markets can't fall further from here. And in fact, if we do enter a recession as we expect next year, this earnings line will probably get revised lower and stock prices could very well continue to fall a bit lower than that. But again, just important to understand investor psychology, that although people felt generally much better over here, they generally have less risk over here, right? You feel much better when things are high, but that's also when your risk is really, really elevated. Okay, so let me kind of move on. And Ben, why don't you kind of talk us through a little bit? We've been really active in the portfolios this year. Talk us through a little bit about what we've done and why we did it.
Yeah, definitely. So a few of the changes, we've been really active this year in working in our models and placing trades. Often in the year, we would have 2 or 3 rounds of trades that we do. This year, we've actually traded 5 or 6 times. And so really, we've been working hard, getting things done as the markets have been a little bit crazy this year. And so a couple of things that we did that have worked really well so far are we overweighted deep value stocks versus growth. So coming out of last year, a lot of people were really heavily invested in growth stocks. Those were the stocks that had been doing, really, really well. They were flying up. You've got tech stocks, stuff like that just kept going up. And we actually just at the end of last year even started to shift towards a little bit more towards value. And this year we've shifted into even deeper value stocks, which has been a real big help, as value stocks have done a lot better than growth stocks this year. We've also increased our commodities and materials. That has been one of the only bright spots of anybody's portfolio this year. Commodities have, thankfully, as inflation has been a little bit crazy, commodities have done really well. And so yeah, that was one thing that earlier in the year we increased that a little bit, and we held it all the way through the year, and it's done quite well. We also, again, end of last year and again earlier this year, we increased or decreased the duration on our bonds, and we also increased the quality. Around July, we got rid of our global bonds, and just kind of with all the different things happening in the world, we figured let's just be safe for a little bit for now. We're going to switch to high quality US bonds, shorter duration, and that has also been a big help as the federal funds rate has continued to go up. Longer term bonds have come down quite significantly. So being on the shorter end of the duration spectrum has been very helpful there. We also have implemented a lot of market neutral and bond alternatives. So even our bond sleeve isn't necessarily all pure bonds. We have these market neutral holdings, which are sort of like a bond alternative, in the same way that we have increased our hedged stock positions, which on the stock side of things, this is sort of our stock alternative. We have hedged stocks, which are very much like conservative stocks or stocks with insurance that basically we've bought on them. So if that fall below a certain level, we are able to sell them a little bit, at a certain level and stop the loss on those stocks. We also increased our cash in February just to make sure that everyone had enough cash to get through any distributions they were taking, and make sure that, and actually cash has been a bright spot for the year, as not going down is pretty good when everything is going down. So that has also worked relatively well. Some of the things that didn't work, gold. Gold is not something we've done very often or put into the portfolios, at least as a big chunk here at Simmons Capital Group. But this year it seemed to make sense, as there was some geopolitical tensions on, with inflation, and gold tends to be really good in environments with those different types of things happening. However, this year, the real main problem with gold has just been that the dollar has been so strong, and the US currency has just been so strong this year. People haven't necessarily been switching to gold because the trust in the US dollar has just skyrocketed and continued to be really strong throughout this whole year. And so that has actually caused gold to not be one of our best decisions this year. And we also purchased an inverse fund that we mentioned, I think, potentially on the last webinar. We were just getting into it. And unfortunately, since we bought it, the market is actually, well, I don't know if I should say unfortunately, but the market is higher than it was when we, purchased the fund. And so we've actually, it's down about 3% since then. But we do believe that that's a continued good piece of insurance just to have, depending on where things go. Obviously, it's not necessarily something we intend to hold forever. It's still something we intend to have as a short-term holding. But for now, we still believe that's probably a good piece of insurance to maintain in the portfolio. All right. And so even more recently, just in November, Darren, myself, and Amy finished doing a wave of trades, and we further reduced international stocks. There's just still a lot of concerns around the European Union and recession. The recession that might occur over there could be a lot worse than what we might end up having here, just with different conflicts, Russia, Ukraine, and the energy. It's just going to be potentially really tough over there. So we reduced that a little bit more. We further increased large US value stocks. That's been the theme of the year, is just keep increasing value, and that has continued to do well. On the bond side of things, we actually started moving back up in duration a little bit. We added a holding, that EAIBX, an Eaton Vance holding that just has a little bit, it's not a long duration, but more like a mid duration. And adding that just increased our duration just a tiny bit, about half a year or so. We also slightly reduced mortgage-backed securities. So that's where we took some from the mortgage back and added it to the slightly longer duration. We also made sure, as we rebalanced, we just kept anyone who was a little bit low on cash with distributions, we got them right back up to where we want them to be. And then alternatives. So as mentioned, we have some bond alternatives and some stock alternatives. We increased our sort of stock hedges and implemented holdings in JEPI and FSEP. And Darren's going to talk a little bit more about those in just a minute. But those are a couple more ways we continue to diversify even our alternatives bucket. We maintained our position in commodities. We believe that that's still a good place to be. It's going to continue to act as sort of a diversification piece of our portfolio that will hopefully, move in different directions as everything else, and just keep things moving, hopefully in all sorts of different ways, so that we can have a nice even trend line. We also reduced gold, as we mentioned on the last slide. While coming into the year, we thought gold might be a good place to be. It's turned out that just the dollar has done really well, and we think that that's not necessarily going to be changing right away. So we decreased our gold a little bit. And again, as mentioned, we are maintaining the inverse stock fund, as we do believe that it's a piece of insurance that we think still makes sense for the coming environment. And we'll continue to monitor and be very proactive there. All right, so this is a sample of our sort of 60-40 portfolio. You can see there's a whole bunch of different colors going on there. And we've got a large portion. That purple is our hedged stocks. And so that's almost, 24% of the portfolio is this hedging. And that's really just kind of like a conservative stock play. As mentioned, Darren will go a little bit deeper into one of the newer holdings we added, but we've still sort of got some of the mainstays that we've had in the portfolios for a while on the alternatives and hedged side of things. You can also see we have, just under that, the orange is that inverse fund that we're still maintaining for a little while longer. And then you can see we've got all these sorts of different types of stocks that are just kind of broken out so that we can really how we manipulate things very specifically. We know we've got in specific international fund, a specific growth fund, a specific value fund, and you can see that overweight in value at the moment compared to growth. On the bond side of things, you can also see that we don't necessarily have any long-term bonds, but we did increase those intermediate term, and that's now actually a little bit larger of a pie slice than the short duration side of things. We've still maintained those commodities and precious metals up near the top left, and then we still maintain about just under 6%, in money markets and stock-like investments.
Great, thank you, Ben. Great job. And it's been extremely helpful having Ben just kind of being able to be really agile, proactive with the models. And a year like this is really when we want to do that. We're certainly not day traders. We're not going to be ever trading on a daily basis, but it's extremely helpful to be able to act quickly in response to an ever-changing environment. So appreciate all your work, Ben. We mentioned just kind of one particular holding on the hedged positions that I wanted to highlight, and we're not going to go deep into anything tonight, but I did want to kind of highlight this as a tool. I think more and more in environments like this, you do have to think a little bit creatively. You have to maybe diverge a little bit from the things that traditionally have worked. And one of the things that we've been really interested in for quite some time, probably looked at these for the last year and a half to 2 years, are things called buffered ETFs, or defined outcome investments, basically. And so forget about all of this part of the chart. Just look really on the far left here where my cursor is. Essentially what these do is they're based on stock indexes, right? So essentially there is always a reference asset, and then there's the fund that we actually own. So in blue is the fund we own, the reference asset is in yellow or in gold, and the reference asset in this particular fund that we own for you is essentially the S&P 500. It's SPY is the ETF. Essentially what this does is these reset every single year. So there are basically our different month ones. So we bought FSEP, which is basically the September version of this particular fund, but they reset. There's a F November, there's an F December, January, February, et cetera, et cetera. And essentially what happens is, when you buy these and when they initiate at inception, they can structure the options portfolio, and options are really just contracts that allow you the option to buy or sell, a stock or a stock index at a specific price in the future. So what they're doing is they're buying 1-year options, which is why they reset every year, every 12 months. So like this one resets next September because it started this September. And essentially what happens is that, you start out at 0, and this particular fund has a buffer or protection that's set up from 0 to -10. In other words, if you buy this at this specific date and you ultimately see the S&P 500 fall 10% and no further, just 10%, you will be pretty much flat for the year, right? If it holds like that for the rest of that 12-month period, because at the end of the day, the options mature and you're able to have full protection for the first 10% down. Now, if the market continues to fall below 10%, you will be now participating in that market, right? You will be falling with it. So ultimately, if the market is down 20%, you will be down 10. You're out for the first 10, you're in for the second, right? So that's kind of how it buffers the downside in a very kind of contractual options specific way. Now, what's the trade-off, right? Because we know you can't just have downside protection without giving up something on the up. So the upside cap is really the drawback, right? That if the market suddenly turns around tomorrow and shoots up for the stars and goes past this cap, we're only going to participate 1-for-1 up to the cap. In other words, if the S&P goes to 30%, we're only going to get 23.41% of that. So the way we look at that is to say, okay, in the current environment, probabilistically, do we feel like it's a fair trade-off to think that the market could go 10% further down from here? Yeah, I do think so. Do I think that it's very viable that this market is going to zoom past 23% higher in the by September of next year? Probably not. And even if so, probably not by much, right? So I think it's a fair trade to kind of make for the protection on the downside without that much, in my mind, of concession on the upside. So, get a little bit complicated, but I do want to kind of just highlight some of the tools that we have available and that we have implemented across these portfolios, because I think that there are a lot of valuable strategies at our disposal that are really useful in the current environment. So as Audra has said, at the end of every recession, at the end of every big drawdown is generally an opportunity, right? And so as investors, we need to be optimists at heart. We need to be able to play defense when appropriate and be realistic. But I think we in general need to be looking for opportunities that develop ideally out of when other investors have become panic stricken and are selling things for really cheap. So a couple of opportunities that we're seeing right now as we sit here is that for the first time in quite some time, investors with a lot of cash on hand suddenly have some options and opportunities to earn some money and returns on their cash balances. CDs, fixed annuities, kind of in the range of 4.5% to 5% currently. Really attractive, the best rates we've seen for quite some time. So if you're sitting on a lot of extra cash, give us a call. We can certainly talk through some options there. On the other side, bonds are suddenly, I think, becoming quite attractive. And I wouldn't thought that I would be saying that ever, but ultimately bonds are becoming quite attractive. Treasuries, munis, other corporate bonds, even, if you have a bond, generally they get issued at about $100 per bond and they mature at $100. So between issuance and maturity, a lot can happen. We've seen that this year where because rates have risen, bond prices have fallen down. But at the end of the day, provided that the borrower doesn't default on their debt, they will mature at $100. Right now, if you look at the bond aggregates across the US, the average bond is trading at $86. So that's not a bad deal. That if you can buy a bond for $86 and you know that it matures at $100 in, let's say, the next 3 to 5 years, that's a pretty attractive offer, a pretty attractive deal. So the drawdowns we've seen in bonds this year have been really painful, but at the same time, it does present opportunities. So it's really important for us to continue to look for those and to be pretty proactive. We're trying to take advantage of buying things that are now pretty cheap after being sold off. And then again, as I've mentioned, we'll continue to look for attractive entry points to add back to stocks and bonds in the coming months and quarters. You know, the key is really trying to manage risk in the downturns so that you're not losing as much as you otherwise would in the more traditional, more aggressive positions, and then hopefully taking advantage of that to be able to go back the other way and take advantage of those opportunities with some dry powder that you have. I'm going to leave you with an optimistic, positive quote here for you. And this is again from a gentleman called Morgan Housel. Highly recommend his reading and writing, extremely smart guy. A big takeaway from economic history is that the past wasn't as good as you remember. The present isn't as bad as you think, and the future will be better than you anticipate. You know, I think throughout history, kind of going back to this chart that Audra showed you, I think that that is true, right? In the times, in these red times, it can feel really scary. It can feel really tough to deal with. And there is obviously real pain. People do lose jobs in recessions. People do lose money in houses. So it's not to be flippant about it, but as investors, I think we have to continue to look towards the future and understand that ultimately the future, I think, will be better than we anticipate. And the present, as we sit here today, is generally not as bad as we think. So I hope that that's helpful. Please feel free, if you have any questions, you feel free to submit them through the Q&A or the chat bar. You can also raise your hand. There's a little option to raise your hand. And if so, we can actually allow you to talk through your microphone. So if that's preferable to you versus typing a question, more than happy to do that. So I'll give you a minute or two just to kind of submit some questions. If you have them, we'd be more than happy to walk through them. All right, so Matt asked a very good question. What are your thoughts on the tech sector for 2023? Great question, Matt. You know, the tech sector has been really the hardest hit this year. If you look at growth stocks versus value, and Ben spoke a lot about our overweight towards value, growth is more technology, and generally those stocks are down, those indexes are down 25 to 30%. Versus, you know, kind of more like maybe 5 to flat for the value stuff. So it's definitely been a challenging area. And the reason really is that when you're looking at technology stocks or any stock that's a growth stock, that means that ultimately it may not be profitable or that profitable today, but we expect it to be really profitable in the future. As rates rise, the formulas that people use to value these stocks are heavily impacted by what's called the discount rate or the interest rate that you're paying. And a rising interest rate environment drastically reduces the valuation of those stocks. So that's really what's been really challenging. So I would say my outlook for the tech sector, at least let me say for the back half of next year, is quite positive, because I think by then we likely will have a either flat to maybe declining interest rate environment, especially if that kind of coincides with recessionary timeframes. Generally, rates are probably going to come down during those times. And I think, you know, that could be a really attractive entry point back into that sector that's been really beat up this year. Because again, we could have stabilizing interest rate hikes, and we could also have then a lower growth environment. And in those situations, growth stocks tend to do quite well. So I would say it might be a little early because I still think that we still have a bit of a road to hoe relative to rising rates as we kind of continue to fight against inflation. But I think once we get through that, the tech sector could be very interesting. And we actually already have a couple of positions on our watch list that we kind of are keeping, that we've scrubbed already, and that we'll look to redeploy in the tech sector if we feel like there's a turning point that's attractive. Great question, Matt. Thank you. Any other questions? What other questions do we have? Let me just go back to a quick question that Sue asked. So Sue, earlier in the presentation, submitted this question that I showed here, that ultimately 93% of mutual fund categories had lost money in this given year. And she had correctly made reference to the fact that this chart is from the end of August, and hasn't the market drastically improved since then? Yes, it has. But at the end of the day, it hasn't improved drastically enough that those categories have turned positive, right? So although markets are less negative, they're still negative, right? So ultimately, those metrics are still holding pretty steady. They may have adjusted slightly, but they're holding pretty steady. Mark, you had asked the question, there's a market adage that says, don't fight the Fed. Do you agree? And how do you see this as applicable at this point in time? I do. I have really come to learn that the hard way. Don't fight the Fed, just to kind of explain that, basically means that if the Fed or the central bank is moving in any given direction, either they're raising rates or they're cutting rates, ultimately the markets are going to follow very closely in line with what they're doing. If they're cutting rates, generally that's a positive for the markets, and the market's probably going to rally. If they're raising rates, the market is probably going to fall, right? Because things are getting more restrictive. So that's the adage of don't fight the Fed. And I wholeheartedly agree in that. You know, we saw it during 2020, kind of coming out of the pandemic. Everything was in free fall. The Fed basically came in and said, hey, we're bringing out the bazookas. We're going to essentially cut rates to zero. We're going to do all of these different programs. And the market kind of did a V-shaped recovery and you know, was incredibly strong on the recovery all the way through as the Fed was continuing to stimulate the economy and the markets. Now we're in the opposite, right? The Fed has been very clear about the fact that they are raising rates. And I actually took a quote from Jerome Powell's speech today that he said, we will stay the course until the job is done. Now, I interpret that as, to be honest, fairly negative, because I don't think that inflation is just going to roll over very easily. So, you know, for me, the adage of don't fight the Fed right now says we should probably remain quite defensive, because they seem pretty serious about the fact that they do not want runaway inflation, and that they'll do what they have to, whether it inflicts pain on households and businesses, as he said in the past, whether it causes a recession. They seem pretty intent that they are trying to break the back of inflation. And so ultimately, I would say at this stage of the game, don't fight the Fed, to me, would say, hey, let's start to, you know, continue to be defensive. And it's not quite yet really until the Fed says, okay, we see significant improvements in the inflationary environment, and we're likely going to slow down or stop the pace of rate increases and maybe start cutting rates. Then I would say, hey, maybe that's a time to go back the other way and start to be more aggressive. But that's a really good question, Mark. Thank you. Any other questions? This has been really great. I really appreciate the feedback, the questions. No hand raises. Ben, Audra, do you see anything else there that I'm missing?
No, but I'll ask you a question.
Oh, no.
Maybe it's something some others were thinking. Obviously, we've been carrying our hedged equities for quite some time now. And now we're introducing this buffered ETF that has a similar methodology. However, the upside opportunity doesn't seem to be quite equal to what we're able to harvest with a hedged equity. Why would we do this as opposed to increasing our hedged equity?
That's a great question. I think, number one, I would say that I think the upside potential in this is actually quite equal to the upside in a regular hedged equity position, which normally in those funds, which kind of makes up this portion of the portfolio here, I don't expect to get more than 60 to 70% of the upside in stocks anyways, in those positions, because that's the trade-off for the insurance on the downside that you're getting, right? On this side of things, you would have to have the market rally all the way up through 30% and be capped out at 23 to have a similar kind of profile of upside, 60 to 70% of the upside. And do I feel that the market's going to go up that much by September of next year? Probably not, right? So that's really why I like it, because the buffer is immediate. It starts now versus only kicking in when the market's fallen another 10 or 15 or 20% from here. So it's an immediate buffer with, I think, a very attractive cap, because I just don't see the market really rallying through that significantly by the time that this matures next September. It's a great question. Well, we are right on 7, which is unusual, but this has worked out pretty well. If there are no more questions, we certainly appreciate it. Thanks, Audra and Ben, for being part of this. Don sends his regards. He just had his first grandbaby. So we're excited about that around the office. And certainly he sends his regards and his good wishes. Certainly feel free to call us with any questions specifically about your portfolios. We're always happy to look at those accounts with you in more detail. But if we don't speak to you before, please have a wonderful festive season. Please let us know if there's anything we can do for you prior to the end of the year, and let us know if you have any additional questions. But thanks so much for joining us. We really appreciate it.
Happy holidays.
Happy holidays. Bye-bye.